Snowflake reported quarterly financial results that sent the stock price down more than 13% following the release of the news. Of course, I told investors not to buy Snowflake stock because it was too expensive weighed against its prospects going forward. I'll update that recommendation in this video. I'll review Snowflake's latest financial results and update my rating on Snowflake stock. So let's get into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So in its latest quarter, Snowflake reported product revenue growth of 30%, although the revenue growth for this company has been decelerating considerably, and that's partly the reason why the stock price has been performing so terribly over the last several years. Snowflake stock price trading at $117 per share as of this recording, down considerably from 5 years ago where it was trading at over $200 per share and down from its peak valuation of over $400 per share. I've not had Snowflake stock rated as a buy ever in this last 5-year period since I've been covering Snowflake stock. I've had it rated as a hold, and my reasoning was that although the company was excellent, not everything about the company was excellent, but it has always traded at a premium valuation. So my reasoning was if I'm paying such a premium price for Snowflake stock, I want all of its metrics to be perfect, which they haven't been. And one of the areas has been the declining revenue growth rate and the decelerating net revenue retention rate. And so while if I was looking at a company that wasn't expensive, I could overlook those factors and still recommend the stock as a buy, but not when it's trading at a premium price. So that's been my reasoning so far over the last 5 years regarding Snowflake stock and why I've told investors not to buy it at any point in the last 5 years. Remaining performance obligations is an important metric when you're considering companies like Snowflake that have a considerable portion of this number. Now, remaining performance obligations eventually turn into revenue. So when remaining performance obligations are increasing, that's typically a good sign for a company's revenue growth in the future. And in the second quarter of its fiscal year 2025, Snowflake's remaining performance obligations increased from $4.988 billion up to $5.231 billion, a significant increase quarter over quarter, and its RPO is at its highest point it's ever been, eclipsing the previous high of $5.175 billion. The net revenue retention rate is also important. This number, if it's over 100%, signals that existing customers are spending more with you in their second full year of service versus their first full year of service. And to me, this is an evidence of a customer value proposition. How much value are customers getting from your service? And it's a core investing thesis that I look at when I'm considering a company. Because if they're not offering a good customer value, then the prospects for the company longer term are not very good. Now, in addition to offering a good customer value, a company has to have good financial metrics, because you can offer great customer value if you're willing to absorb losses on the bottom line. You would be extremely happy with my service if I offered you $1,000 worth of value and only charged you $25. But my business wouldn't survive because I would be losing so much money by doing that. My prospects longer term would not be viable. So there's a balance that companies have to play in terms of offering good value to customers, enough so that they keep coming back, but doing so efficiently enough where it generates profitability for the company. So that's the challenge in business. Snowflake does have a solid net revenue retention rate of 127%, signaling customers this year spent 27% more with Snowflake than they did the same quarter last year. But my only issue with Snowflake's net revenue retention rate has been this consistent decline over the last 3 years. And they have a chart here going back 1, 2, 3, 4, 5 quarters. But if they went back 10 quarters, you would see an even more declining net revenue retention rate. This is now 4 consecutive quarters of declining net revenue retention rate that you see here. And like I mentioned, if they had a chart going back further, you would see this streak going down for much longer than these 4 quarters. So that's one of my complaints with Snowflake stock. That has been one of my complaints with Snowflake stock, because it's traded at a premium valuation, and this very key metric, along with the growth rate in product revenue, has been decelerating. Which, like I mentioned, if it wasn't so expensive, you can overlook this metric and say, well, it's okay because you're getting the stock at a good value. But up until now, up until these last 5 years, I've been following the company. It's consistently traded at a super premium valuation. And if I'm paying that super premium price, I want everything to be just right, which it hasn't been for Snowflake. Now, its margins have been improving. Non-GAAP operating profit margin came in at 8% in fiscal year 2024, up from 5% in 2023, and the adjusted free cash flow margin increased to 29%, up from 25% in 2023. The company is a software as a service, which has lucrative profit margin prospects longer term, and so that's one of the areas where Snowflake has done an excellent job, and its cash flow from operations to sales ratio has also been great. The company's guidance for fiscal year 2025 is for product revenue of 3.356 billion, up from 2.7 billion in fiscal year 2024. So they are forecasting growth ahead, although the growth rate will decelerate again down to 26% in 2025, from 38% in 2024, from 70% in 2023. And you get the picture. Its revenue growth rate is decelerating. The rate of growth is decreasing. I've talked a lot about the second derivative, not just the growth rate, but the change in the growth rate. Is it increasing or decreasing? And if you have a company with a decreasing rate of growth, then you shouldn't be willing to pay as high a valuation. And Snowflake, as I mentioned, has been super expensive with the decelerating second derivative. So that's been another factor that I highlighted that has been undesirable in terms of long-term investing characteristics. Now, operating profit margins are also expected to drop in 2025 for Snowflake, down to 3%, down from 8% in the previous year, and that is expected to end its trend of improving non-GAAP operating profit margin, and similar with its non-GAAP adjusted free cash flow margin, which had been improving consistently. The company's forecasting a drop in this metric as well. So you can understand why Snowflake's stock price dropped by more than 13% following the news. It's now trading at $117 per share. And like I highlighted, I told stock market investors not to buy Snowflake stock, and I last updated that recommendation on May 24th. However, given all of this stock price drop in Snowflake, it's now trading at a reasonable valuation. Snowflake is trading at a price to free cash flow of 48, the cheapest this stock has been in a very long time. I can go back several years and you haven't been able to buy Snowflake stock, save for a brief moment, at this valuation. So given the valuation decrease, I'm upgrading Snowflake stock here to a borderline buy. I've always liked this company. I've thought it's been an excellent company with great prospects longer term. However, my only drawback with the company has been the super premium valuation. It's no longer trading at a super premium valuation, so I can forgive some of those undesirable characteristics, like a decelerating revenue retention rate and a decelerating revenue rate. So I'm upgrading Snowflake stock here, borderline buy, as of August 22nd. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.